Most people think that taxes are complicated, and that belief alone can cost them money every single year. The truth is that taxes are not driven by dozens of complex strategies. They are driven by a few simple levers that actually move the needle. You do not need to be a CPA, you do not need to know tricks or loopholes. If you understand a handful of basic concepts, you can meaningfully lower your taxes every single year. In this video, I'm going to walk through 6 of those core concepts in plain English. No jargon, no technical explanations, just simple clarity so you actually understand how these decisions show up on your tax return and why they matter over time. The first lever is your 401k. When you contribute to a pre-tax 401k, that money comes directly out of your paycheck before the IRS calculates how much tax you owe. Let's use a simple example. If your household earns $200,000 and you contribute $20,000 to a pre-tax 401k, you are no longer taxed on the $200,000. You are taxed on $180,000. That is all pre-tax means. You lowered the income number the IRS uses to calculate your taxes. The higher your income, the more valuable this becomes because you are reducing your income that would have otherwise been taxed at higher rates. This is why pre-tax contributions tend to matter most during peak earning years. A Roth 401k works in reverse. You pay taxes now, but the money grows tax-free and comes out tax-free later. For example, if you contribute $20,000 to a Roth 401k, you still pay taxes on that $20,000, but every dollar of growth into the future comes out tax-free. Roth is a great tool in lower income years, but for many high income earners, pre-tax contribution usually create the bigger benefit today. The question you have to ask yourself is, will you be in a higher tax bracket into the future than you are right now? The second strategy we're going to talk about is the health savings account, otherwise known as the HSA. An HSA is only available if you are enrolled in a qualified high deductible health plan, so not everyone can use one, and that is important to understand upfront. If you are eligible for an HSA, every dollar that you put into it comes off your taxable income just like a pre-tax retirement contribution. The account can grow over time and withdrawals are tax-free when used for qualified medical expenses. It is the only account that the money goes in and you get a tax deduction. It can grow tax-free, and then when you pull it out, it is also tax-free if it's for qualified medical expenses. Many people treat their HSAs like short-term spending accounts, but they can also be invested and used later in life for healthcare costs. The HSA is not a flashy decision, but if you qualify, it is a straightforward way to lower your taxes and plan ahead for medical expenses. The third strategy we're going to talk about is understanding the difference between the standard deduction and itemizing your deductions. For 2026, the standard deduction is $32,200 for married couples filing jointly and $16,100 for people who file single. All this means is that if your household earns $200,000, the IRS automatically lets you reduce that to $167,800 before calculating taxes. But you can choose to itemize your deductions instead if your deductible expenses are higher. When looking at itemizing, not every expense counts, and there truly are 4 of them that you should look at. It's your mortgage interest, your health expenses over 7.5% of your AGI, your state and local taxes, and then your charitable contributions. Now let's look at an example. Let's say you pay $30,000 in mortgage interest, you give $5,000 to charity, and you pay $10,000 in state and local taxes. That adds up to $45,000 of itemized deductions. Since $45,000 is higher than the $32,200 standard deduction, you would opt to itemize your deductions and lower your taxable income even further. You do not get both, you simply choose the option that reduces your income the most. The fourth strategy we're going to talk about is tax loss harvesting. It sounds complicated, but it is actually very simple. Tax loss harvesting means selling an investment that is down in value so you can use that loss to offset your gains somewhere else, or potentially even use some of it to lower your taxable income. One thing I'll note before jumping into an example is that tax loss harvesting can only happen in a brokerage account. It cannot happen in a retirement account. All right, let's look at an example. Let's say you sold one investment for a $10,000 gain, but you have another investment in your portfolio and it is down $10,000. You can sell the losing investment and use that loss to offset the gain for tax purposes. And if your losses exceed your gains, you can use up to $3,000 per year to reduce your regular income. The key to this strategy is staying invested by buying something similar after selling, but you cannot buy the same investment within 30 days. The fifth strategy we're going to talk about is charitable giving, specifically how you give. I often hear people say, hey, I do not give to charity for the tax benefit. And I totally understand that. The goal is not to give more than you otherwise would, it is simply to give more efficiently. In my eyes, there are three parties involved when giving to charity: the charity itself, you, and the government. If you can reduce how much money goes to the government while keeping your intent the same, that means more money ultimately can reach the charity. One way to do this is by donating appreciated investments instead of cash. For example, if you bought an investment for $10,000 and is now worth $25,000, selling it would trigger capital gains taxes on the gains of $15,000. But if you donate the investment directly to the charity, you avoid paying those taxes entirely, and the charity still receives the full $25,000. And because the charity is a tax-exempt entity, they will not have to pay taxes on the capital gain either. The sixth strategy we're going to talk about is asset location, which means being intentional about where your investments are held. Not all investments are tax efficient, and holding the wrong investments in the wrong accounts can quietly increase your tax bill every year. For example, investments that produce a lot of taxable income, such as REITs, private credit, or high income strategies, are often better held in tax deferred accounts or tax-free accounts like a 401k or an IRA. More tax-efficient investments such as broad stock index funds are usually better suited for taxable brokerage accounts. Being thoughtful about what you own, especially in taxable accounts, directly affects how your income shows up on your tax return each year. Now, here is the part people often get tripped up. These strategies do not have to live in isolation. They stack on top of each other. A 401k contribution lowers your income. That lower income also affects which deductions matter. Your deductions affect your charitable strategies from a tax perspective. Your investment choices affect whether tax loss harvesting and asset location actually help. This is why tax planning becomes more important as income rises. Not because things get trickier, but because the interactions start to matter more. Most mistakes I see are not people doing the wrong thing. They are people doing the right thing in the wrong order or without seeing the full picture. Some common examples I see are high earners defaulting to Roth contributions without considering current tax rates, skipping HSAs because the account feels small, giving cash instead of appreciated investments, or building taxable portfolios full of high income producing investments. Another big mistake I see is assuming your CPA is proactively planning when in reality they are often focused on filing accurately, not optimizing your decisions throughout the entire year. And this leads to an important point. These are not the only tax strategies that exist. They are the most universal and repeatable ones for W-2 earners. Beyond these, things start to become more situational. Concepts like Roth conversions, backdoor Roth contributions, mega backdoor Roth strategies, timing income across years, or coordinating retirement withdrawals can all play a role depending on your income level, benefits, savings rates, and long-term goals. These strategies can absolutely be very powerful, but they require context and coordination to get right. That is where ongoing planning matters even more than individual tactics. It is not about chasing every possible strategy, it is about understanding which ones apply to you, when they apply to you, and how they fit together over time. Those 6 core levers form the foundation. Everything else builds on top of them. That is exactly what I walk through in my $199 financial plan. Not theory, not generic advice, a clear view of your numbers, your options, and the trade-offs involved so you can move forward with confidence and stop second-guessing your decisions.